So we're going to talk about today on why 3 million ARR is actually not enough to raise your Series A. What investors are actually looking for and what's the actual story that they want. VCs, that doesn't mean that VCs want to see profitable companies that have low growth potential. They still need venture scale. They just need to see venture scale in a capital efficient way. And what VCs are really looking at you for around that seed to Series A time is what will capital efficient venture scale look like for you and your company? How are you going to hit 3x growth year over year for those first 2 years or 10% month over month growth compounded for 24 months straight? The problem is that product market fit is unique to each individual company. And that's why there's not a standardized definition out of there. First, you need a way to make happy customers. So your product has to be able to generate happy customers. Happy customers is really hard. Building the product's easy. Building a product that actually produces happy customers that you can prove is really, really hard. More features, more tactics, more whatever. And this cycle just kind of becomes a negative death spiral. Your first goal is to find something that works. Once you have something that works, do it more often, shift out of experimentation mode and into execution mode. And then once you've actually proven that you can execute it, then you can start finding more things that work and just repeating this process. Your Series A round is all about taking that thing that already works, shifting out of experimentation and into execution and doing it more often and hitting that venture scale, early parts of that venture scale curve. Your Series B is about expanding out your total addressable market and expanding out either with new products or new markets to keep finding more things that work.
Let's get started. Okay, everyone, again, welcome back. Today we get together with Michael, a former VC and an exited founder from Canada, which give us valuable insights with a presentation about scaling from C to Series A. We're thrilled to have you, Michael. Thank you so much for joining us today. So without further ado, let's get started. I will introduce to Michael. I will give the stage to Michael to introduce himself, and we will dive into his presentation and so on. Michael, thanks for joining here. Really appreciate that you're joining in really different time zones from us. So stage is yours.
Great. Cool. Well, thanks. Appreciate the introduction and the opportunity to come and talk to you all here. Let's talk about how do you go from seed to Series A, whether you're a pre-seed company, a seed stage company, or you're actually getting ready for your Series A. I feel like Series A is that milestone that everybody has because it lines up nicely with product market fit typically. And so we need to know what that's going to look like, or we need to have a hypothesis of what that's going to be. So we're going to talk about today on why 3 million ARR is actually not enough to raise your Series A. Historically it was you hit $1 million in revenue and you'll automatically unlock your Series A. Now people talk about, the minute you hit 3 million in ARR, now you're ready to raise your Series A. What we're going to talk about is what investors are actually looking for. Revenue is a lagging indicator and investors are looking for leading indicators. And so we want to talk, what are investors actually looking for and what's the actual story that they want to hear? Quick background on myself. I help founders prep for their Series A, and then I help them run processes that'll help them get multiple competing term sheets. We're going to talk a little bit about Ignacio and his $10 million Series A, where he got 7 term sheets. Charlie's $12.5 million Series A, where he was able to get 4 term sheets. A $21 million Series A by Maxa, where they were able to get 10 term sheets for their round, and a $25 million Series A by a YC-backed company is just not announced yet. All of these raises started with the framework that I'm going to talk about here today and share with you all. There's a great quote by a guy by the name Zig Ziglar, if you're familiar with him, one of the original productivity gurus way back when, that says, you can't hit a target you cannot see, and you cannot see a target that you do not have. When I was out fundraising, I'll be honest, I didn't quite understand what were the milestones that are required to actually unlock my next round. I just thought I raised money and 18 to 24 months later, I'll raise money again and my valuation should go up. And then that next round will be my Series A after my seed round. What we're seeing though is that the graduation rates are actually dropping, right? So typically the graduation rates 2018 and sort of before that for those cohorts was about 31%. So after 2 years after they raised their seed round, 31% of companies would typically graduate to their Series A. During the boom times, that floated up to 20 in for the 2020 cohort to 40%, and it's since sunk down well past 31%. We're now sitting at about 15 to 17% that are graduating to their Series A. What does that mean? That means that bridge rounds are rising because typically you raise about 24 months worth of runway for your seed round, which means if you don't graduate to Series A, and you don't get yourself profitable, it means you're almost out of money and you have to go back to the well and raise more money. So about 42% of companies are now raising a bridge round between their seed and Series A. Now we're getting more clever. We don't call them bridge rounds anymore. We call them seed extensions, seed twos, pre-A rounds, A prime rounds. We just call them all different names. But at the end of the day, it just means you've missed your milestones, and it means you're burning an extra 15 to 20% equity that you otherwise would rather not, because you'll never get that money back. So that's what we want to talk about today. What's the goal of your seed round? When are you actually ready to raise a Series A? And then why is this concept of going from seed to Series A this repeatable building block that you're going to use for the rest of scaling up your company and the rest of your alphabet round, Series B, Series D, etc. as you scale? All right. A little bit more background on myself. I started my career as an engineer at a company called Nortel Networks, if you remember them. This was before the dot-com crash or the dot-com era. I was writing software for their Japanese line card. Then I moved into sales after the dot-com crash for a startup that raised $20 million pre-revenue. I started with them shortly after they raised, was in sales, and then stayed with them as we went from zero to almost $100 million in revenue and went public. Shortly after that, that's when I started my company. This is around the Great Recession timeframe, so not a great time to start a company, but started my company, raised a bunch of venture capital, and then grew that company for 6 years before we sold it to one of our partners called Audience Partners. And then I became CTO and head of product for Audience Partners, and we sold that company 3 years later to a company called the Altice USA, which was the fourth largest cable company in the US. After taking a year off, I became an investor. After sort of seeing a bunch of operating roles, I wanted to see what it was like to sit on the other side of the table and actually be a VC and see what goes on behind closed doors and understand the psychology that investors have when they're looking at deals. So I spent 5 years as a VC and learned kind of two things. One, I learned that being a VC wasn't actually for me. I enjoy much more the operating part. But the second part that I learned was I actually loved working with founders, rolling up my sleeve and helping them actually get themselves ready to raise, whether it was for a seed round when I was looking to do a deal with them, or our portfolio getting ready for their Series A. And so that's what I do now is I help companies prep for their rounds and then help them figure out how to run processes that will create as much deal tension as possible so that they can get multiple term sheets. If we're going to talk about how to go from seed to Series A, and we're going to talk about what the actual milestones that you need for your Series A, then we have to start with investor expectations. And by that, we need to define venture scale. So whenever an investor is looking at your company, they're looking at it through the lens of, will you be one of the companies that can hit venture scale? The easiest definition of that is when you hit $1 million a year in revenue, will you be one of the few companies that go from $1 million to $100 million in about 7 to 10 years? About 1% of companies will do that. But they're trying to figure out, do you have the potential to do that? Now, that means when you hit $1 million in revenue, a common way of thinking about this is you'll triple revenue the first year. After that, you'll triple revenue again. Then you'll double, double, double all the way to 100 million. So triple, triple, double, double, double. What I want to draw your attention to though is at the beginning, right? When we're talking about seed to Series A, you're somewhere in that sort of $1 million, $3 million range typically, but it's more about are you going to be able to hit this triple triple back to back? Now, if you do the math on that, that means you'll be growing at 10% month over month for 24 months straight compounded, right? That is incredible growth rates. And that's sort of the simple definition to think about when you're raising your Series A is are we doing this and do we have the capability to continue to do this? During the boom times, a bunch of people sort of played with these numbers a little bit and they showed top line growth by just raising some venture capital, using paid ads or whatever other acquisition channel they needed to do, and burnt through that capital to show top line revenue growth, but only to have customers churn on the back end or to be completely unsustainable. We now kind of know, Sequoia's gone on record, almost everybody talks about it now, that growth, that this concept of growth at all costs is no longer being rewarded. The thing though that I think most people miss with that is that VCs, that doesn't mean that VCs want to see profitable companies that have low growth potential. They still need venture scale. They just need to see venture scale in a capital efficient way. And so this is kind of what it always should have been, what it was before. This is why it feels like the bar has risen, but this is just the way it's supposed to be. This means that you have true product market fit when you can scale in a capital efficient way and hit these kinds of growth curves. So today, we're going to talk about the missing go-to-market slide. So the one slide that captures this concept of capital efficient venture scale growth that's missing from basically every pitch deck that I ever see. We're going to talk about how Uber went from zero to $10 billion in 10 years. And we're going to use that story to go year by year so you can actually see this framework unfold. Now, Uber's obviously not the poster child for anything capital efficient typically, but that's because there's two parts of capital efficiency, and almost everybody focuses on the one that they did poorly. The one where it was bad unit economics. They were using venture dollars to basically offset the costs for customers. And it seemed wildly unprofitable. Now, we know that they've gotten profitable now, but there's a second part to capital efficiency that we're going to talk about today. And that's the part that I don't think enough startups focus on. And it's the most important part when you go from seed to Series A. Now, because your business model is going to be different, most likely, than Uber, we're going to talk about how to make it work for you. And then we're going to talk about what investors want to see throughout this process so you can start building your own roadmap from where you are all the way to your Series A milestones, and you'll know when you're going to be ready to raise that round. This is all based on a framework that I've been working on since I sold my company. I call it priority mapping. When I was studying productivity, or going deep into productivity on my year off, I came across this quote, and it was the quote of a billionaire telling one of his mentees on what the secret to his success was. And he said the secret was quite simple. It's to do less, do it more often, and keep getting better at it. And generally, when I look at my life, when I've been struggling, it's because I'm doing the exact opposite of this. I'm trying to do too many things. And because I'm trying to do too many things, I don't do any one of those things more often. And because I'm not doing it more often, I'm not getting better at it. And then because I'm not getting better at it, I start to panic and I start to try to do more things, more features, more tactics, more whatever. And this cycle just kind of becomes a negative death spiral. It really sort of started to open my eyes to what's the secret to success for a startup. And the secret to success for a startup is actually quite simple. Your first goal is to find something that works. Once you have something that works, do it more often. Shift out of experimentation mode and into execution mode. And then once you've actually proven that you can execute it, then you can start finding more things that work and just repeating this process. Find something else that works, do it more often, and then keep finding even more things that work as you scale up over and over and over again. It also lines up nicely with the round definitions. So your seed round is all about finding something that works. Your Series A round is all about taking that thing that already works shifting out of experimentation and into execution and doing it more often and hitting that venture scale, early parts of that venture scale curve. Your Series B is about expanding out your total addressable market and expanding out either with new products or new markets to keep finding more things that work, which just means that you have to repeat this process over and over and over again. So we're going to talk about how Uber did this, but we're also going to talk about an enterprise sales play, a B2B SaaS company, a consumer, and a moonshot or a deep tech company. So you can see that it works across a lot of different business models. Okay, first things first, the missing go-to-market slide. Most go-to-market strategies are presented in sort of two ways. Here's how we make money. Here's how we're going to grow. It sounds reasonable enough, but it usually misses a core component of this. So let's talk about how we make money. There's two parts to it. One slide, two slides, every deck will be different. Part one is how does your pricing model work? What's an average customer worth? What do your actual pricing economics look like? This is the sort of foundation to understanding your business model. So what is the way you charge customers? And then the second part, which is often confused with your go-to-market strategy, are the tactics that you're using to grow. Are you using a sales-led motion, a PLG motion? Are you using communities? Are you using webinars? Are you using content? Are you using network effects, word of mouth, viral K factors? What are you actually using as a growth engine and tactics behind your model? Both of those just tell us how you're planning to make money. Unfortunately, everybody jumps to this slide next. And here's how we're going to grow. First, we're going to do this thing called Uber Black. Then we're going to do this thing called Uber X, then Uber Pool, and then Uber Eats. Unfortunately, all that we hear as a VC is to grow, we're going to do something different, then something different again, and then something different yet again. And different means slow, untested, and expensive, right? Which is exactly the opposite of what we're looking for when we say capital efficient venture scale growth. So we want to avoid this part. So what VCs are really looking at you for around that seed to Series A time is what will capital efficient venture scale look like for you and your company? How are you going to hit 3x growth year over year for those first 2 years or 10% month over month growth compounded for 24 months straight? This slide has now become the most important slide you're going to be talking to an investor around your Series A about because they're trying to diligence, will you or will you not hit venture scale in the next 2 years, i.e. the time frame that you are going to be using the capital that you're raising at your Series A. So we're going to look at Uber. We're going to go year by year and pay attention to 2011 when they raise their Series A. So Uber started with a big, giant, multi-billion-dollar market, basically like every startup out there. Theirs from their pre-seed deck was $4.2 billion annually and growing. So arguably small, but at the same time, multi-billions of dollars. It's kind of in that sweet spot that VCs like to see. Sometimes they want to see a bigger total addressable market nowadays, but nonetheless, it's large. And like every startup, it's hard to imagine now, but like every startup, Uber started with limited resources, which means that they couldn't tackle the entire market on day one, right? And so now they've got to prioritize. They have limited resources and they've got to figure out what their go-to-market strategy is so that they can maximize their resources. So what they do, 2009, they were founded and they raised $200,000 in a pre-seed round. So not a large pre-seed round, still very limited resources. And they famously started with Uber Black in San Francisco. Now that is a tiny, tiny, tiny sliver of their overall $4.2 billion market. My guess that's less than $100 million total addressable Uber Black in San Francisco. First thing they do, they find something that works, right? So they raise a $1.3 million seed round and they get Uber Black in San Francisco to $1 million a year in net revenue to the company. Now, this is where things get interesting. Okay. In 2011, they raised an $11 million Series A. Again, that's about a normal size Series A these days. And what they had was a blueprint for $1 million blueprint for Uber Black in San Francisco. Now, what do most companies do? They go, okay, cool. I got my first product that I don't really, wasn't really my vision. Got it to about $1 million, which means we're crushing it. And I'm just flush with $11 million in capital. So what am I going to do? I'm going to do Uber Pool, Uber Eats, or Uber X, Uber Pool, Uber Eats. I'm going to do all the other things that were in my vision because now I have lots and lots of resources. What did Uber do instead? What was the narrative that they were raising their Series A on? We're just going to take this blueprint and we're going to do it more often. We're going to go copy, paste, 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 paste. We're going to go from San Francisco to New York to Seattle to Chicago, every other major city. We're going to take what already works, all the experiments we've done, and we're going to start shifting into execution mode. What does that mean? They went from $1 million to $5 million in 12 months, in less than 12 months. None of that is easy, and it takes a tremendous amount of effort and discipline to stay focused and to shift into execution mode. But it's the most capital efficient way relative to that company to grow is by doing the same thing that they already know how to do over and over and over again, rather than trying to experiment on something new that's untested, unknown, and expensive. This allowed them to raise their Series B in less than 12 months. And now they're flush with cash with $37 million from their Series B. And if I take 20% of $37 million, that's about $8 million, which looks an awful lot like a Series A raise again, which means I can take 80% of that capital and again double down on what's already working, Uber Black, and take 20%, $8 million, and run a new experiment and test what's going to happen next. Because there's no guarantee that the next thing we do, the next product, the next feature, the next segment we go after is also going to work. So we've got to run back and run our experiments again. So they raised $37 million and they run an expansion strategy. So first things first, they take most of that money, double down on Uber Black, and go from 5 to 15 million. So tripled again at scale. And then they experiment with Uber X. It turns out Uber X works. First, they got to make it work in one city. Then they need to start scaling it up. 2013, they go from 15 million to 105 million in 1 year. So almost a 8x. Raise a $363 million Series C. Most of that money is now coming from Uber X, but Uber Black is still contributing quite a significant amount to that money. 2014, the next year, they go from 105 million to $500 million, and they're just repeating this process over again. They're scaling what already works, and then they're running this sort of seed to Series A process again by launching and testing and experimenting on something net new. In this case, Uber Pool. Then they triple revenue again, finding yet another thing, or starting to experiment on another thing being Uber Eats, but they've gone from 500 to $1.5 billion. And then from 2016 to 2018, they go from 1.5 to 3 to 7 to $10 billion. That's 0 to $10 billion in net revenue to the company in 10 years' time. And it all started with this framework. First, they got to find one thing that works. Then they need to do it more often. Then they're going to go find something else that works. And then they need to do that thing also more often and rinse and repeat this process over and over and over again. Most founders struggle with, and Mile One was no different, with how do we balance between showing investors this big giant vision and what we're going to execute on today. This is what we're trying to do here. Is we're trying to take our big vision, break it down into its big rocks, and then take that first rock and show how we're going to subdivide it, and we're going to line up those subsegments, and that's our go-to-market strategy. And that's how we kind of go from the today to the future, bigger market. And so that's your goal, is if you're going to look to raise capital at your seed Series A timeframe, your goal is to show investors the right go-to-market strategy, which is first find something that works, then do it more often, then you can worry about keep finding more things that work. Okay, now we got to talk about how to make it work for you. And Uber focused on cities. I like Uber because it's easy to wrap our heads around because it's geography based. I don't like Uber though, because everybody here in the presentation goes, yeah, but that's okay. I understand how it can work for Uber, but I'm different. We don't use cities, right? We don't use a city hopping strategy. Cities are just a construct for going from something big into something smaller. So the entire population, we can shrink it down by San Francisco, Toronto, New York, Tokyo, all the different cities that we want to talk about. But cities are not the only way. The company I worked for, Sandvine, that went 0 to $100 million, we didn't focus on where the customers were. We focused on who the customers were. So we took our market and we subdivided into single box deployments, multiple box, multiple sites, Time Warner, Comcast. So we sold to cable companies. And this allowed us to first find our first thing that works. So single box deployments just meant it was a small data center with low enough bandwidth where we could use one of our rack-mounted servers to handle all the traffic for that internet service provider, and we could figure out everything. Does our product work? Gather our case studies. Does our pricing model work? Does our go-to-market strategy work? Does our messaging work? Is our value proposition there? Basically, everything that's required to run our business, we figured out by winning a bunch of single box deployment customers. Then we just kept shifting one to the right, changing as little as possible each and every time we moved to the right. And that's our goals. We want to rinse and repeat what already works as much as possible. Running this little gamut here took us from 0 to $100 million in roughly about 7 years. HubSpot didn't focus on who the customers were. They focused on what problem are those customers trying to solve. So they started with an all-in-one CRM solution for small, medium-sized businesses. None of that changed for the first X number of years in the company and tens of millions of dollars, I'm guessing. You can go actually back in the Wayback Time Machine and you can actually watch their strategy unfold. First, they started with SMB strategy blog posts. There's about 30 of them. Then fast forward a couple months and you can see that all their blog posts, they have about 30 blog posts around internet marketing, then SEO, then blogging, then advertising. So they were clustering around different segments and they were just changing the front door that people came in. Their pricing model stayed the same, their product stayed the same, their messaging stayed the same, their value proposition stayed the same. Everything stayed the same in their execution model. All that was changing was the front door that they were pulling people through when they were searching on Google. Now, because they invented inbound marketing, SEO was way, way easier back then. But the point here being is that all they were changing was the implementation of their go-to-market strategy, not their product, not a different go-to-market channel. They didn't have to go into experimentation mode. All they were doing is change how they were executing on it. Now, Facebook also focused on where the customers were, but instead of geography, they used schools. And what you probably know is that they started at Harvard, but what you might not know is that they didn't choose Columbia, Stanford, and Yale as their next segments or next schools by random choice. They were trying to figure out which schools naturally had an overlap outside of Facebook with people at Harvard. And why is that if you were going to Columbia and you first launched Facebook, they wanted that if you looked at your news feed, you would see your friends that are already at Harvard in your news feed. And so therefore you were able to get value immediately from Facebook. When an investor is asking you your go-to-market strategy, they're trying to figure out what is your logic behind how you subsegmented the market and how you ordered or prioritized those segments and why that gives you an advantage. So it's not just putting something pretty on a graph. It's all about the story that you can tell behind why you are picking that strategy. What learnings have given you confidence that you've got the right strategy. And then SpaceX. SpaceX didn't focus on who the customers were, what problem they're solving, or where they are. They were focused on why do you want to launch a rocket? What's the motivation behind it? Was it for low Earth orbit, geosynchronous transfer orbit? I don't know what any of these mean, but last time I pulled this in Wikipedia, they had 138 launches, which is way more than I thought. And if you looked, you can actually watch their strategy unfold. They've done 45 low Earth orbit, 35 geosynchronous transfer, and you can see the waterfall off from there. Now, why do they have so many low Earth orbit? I don't know, but I'm sure internally to SpaceX, there's a reason behind that. And why they did geosynchronous transfer orbit next, there's probably a reason for that as well. Your goal around your Series A is to be able to defend why you ordered them this way and why you are seeing what you're seeing and which parts you're going to be doubling down on next. When we did this with Maxa and we figured out through their segmentation and their ICPs, we started to notice that there were certain ICP customers, ideal customer profiles, that where our sales process accelerated, our sales cycle was shorter, our average customer engagement was better. And so we were able to build our narrative around that part of our strategy on what's already working now. So your goal through all of this is to not just have the right strategy, but to layer on top, why is this your first thing that works? And where are you going to do it more often? What are the segments? How did you come across them? And why did you order them in the order that you are showing them throughout this process? So we've got the right strategy, and now we know how to put a story on top of it, but that still doesn't really help us figure out where we are and how to build towards our milestones. So if we're going to do that, we now need to define this vague word I've been using, like you've got to find something that works, which basically means we have to define product market fit for you and your company. The problem is that product market fit is unique to each individual company, and that's why there's not a standardized definition out of there. But there's a way to approach it from a first principles thinking standpoint. The simplest way to think of product market fit is two parts. First, you need a way to make happy customers. So your product has to be able to generate happy customers, which we typically call problem solution fit. That happens in and around your seed round. The second part to product market fit is you now need a repeatable and scalable factory that can produce more happy customers on demand, basically. And we call that go-to-market fit. True product market fit, ready to scale, ready to raise $10 million so that you can make $10 million in net new revenue in 24 months, requires both of these things. You need a product that can produce happy customers, and you need a factory that can go get more of those happy customers. Elon Musk had a quote when he was struggling with the Tesla Model 3 production lines that he said, building the factory is 100 times as hard as building the car. That's basically why I think we're seeing such low graduation rates around seed to Series A. Building that car, building your product that can produce happy customers is really hard. Building the product's easy. Building a product that actually produces happy customers that you can prove is really, really hard. You're inventing something completely new, and you've probably dragged your face across concrete to actually get to that point. All of a sudden, you are flush with $3, $4, $5 million in your seed round, and you think, cool, all the hard part's done. What we typically underestimate, though, is that building the factory is 100 times as hard as building the car. There's so much more noise out there. Customers are fickle. Building repeatable and scalable motions is difficult. Just having the discipline to focus on the same thing is really, really hard. You add all of that together, and this becomes a monumental lift and often takes 12, 24, sometimes even longer just to figure out and debug it, because you're dealing with people throughout this process, and it's very, very difficult to do. But if we're going to use this concept to build out a roadmap, we need to define what a factory is. My easy and simple definition of that is A factory is everything that you need to find, win, deliver value, and retain a customer, a happy customer, in a repeatable and scalable way. The key word there, if you're going to build a roadmap for your milestones, is that word repeatable. I think it gets thrown around too much, including by myself, often when I'm thinking of my own things. And so I came up with a simple definition. Repeatable means you've done something more than 10 times. And all we need to do now is add that definition to every single part of your factory. A lot of startups these days can get to 3 million ARR or more on founder-led sales, but that means you have one salesperson that's done a bunch of sales. Where they usually fall down if they raise a Series A at that point in time is that taking the founder-led sales and making that repeatable across multiple salespeople, 10 more salespeople, usually doesn't work in the first go. And so what happens is they start scaling too early. They burn through 9 months worth of runway only to realize that the sales team isn't as good or producing as much as the founder, and then they have to fire that entire sales team. What usually happens though is in the same process, they've ramped up all their other spend, engineering, customer success, product, all of the other departments. Revenue hasn't tracked where they thought it was going to, but costs definitely did. And what they thought was 24 months of runway from seed to Series A or around Series A, sorry, now all of a sudden becomes closer to a year's worth of runway, and they've already burnt through 9 months of that. This is what causes so much pain to so many companies. The simplest way to get through that is find your risk points. Where are you less than 10? It's really easy because we don't need complicated analytics for that. So let's look at Uber and let's look at how they launched their cities. So you can see that in 2010 is when they launched San Francisco. It took them about a year before they launched New York. When they launched San Francisco, basically everything in their factory was more than 10. More than 10 drivers, more than 10 users, more than 10 users that took more than 10 drives. All of the numbers in there, I'm willing to bet very quickly got more than 10. When they launched New York City, they was around when they raised their Series A, and they struggled to raise their Series A. There was one part of their factory that was yet to prove that it was repeatable, which was their city hopping machine. Most Series A investors at the time didn't believe Uber could make this work outside of San Francisco. Finally, they convinced somebody to lead their Series A. They did New York. Then about 6 months later, they did Seattle, then Chicago, Boston. You can see we're starting to pick up the pace on how often they're launching cities. And where I drew that line is where they hit their 10th city. After their 10th city, they went purely exponential. Think about everything you've ever done in your life. Usually the first couple of times you do it, you're just trying to figure out which way is up. Somewhere between 3 and 10 times, you're starting to get a handle of, okay, I know how this thing works. I know what I'm doing. Somewhere around the 10th time you've done something, you could probably start operationalizing it and teaching somebody else, writing a process down, and then start optimizing from there. That's typical for basically every single part of your startup. So it's not just about the revenue. This company here, YC-backed company, far exceeded the revenue that they needed for their Series A. And when they were trying to go out and raise originally, they were just talking about their revenue numbers, and that was it. What we needed to do was show all the leading indicators to that revenue numbers. What were all the parts that were driving that revenue, and were all of those parts repeatable and scalable? That's really the story that a VC at Series A really wants to see and get comfort with. And we need to do a really good job to give them conviction that they are in fact repeatable and scalable, or that they will be soon. So your goal is not just to have the right strategy and tell the right story, but you actually have to back that up with all the right signals that show that it is in fact repeatable and scalable, right? So you want to show that you have something that works, that you know why it works, that it's repeatable and scalable, and you have all the proof points behind it. Then you want to show where you're going to do it next, and you want to show that you've de-risked those. So you don't want all of your revenue in one small ICP. at your Series A because they won't believe that you can do it at your next cities, right? Or your next equivalent of what your ICPs are. So we want to pre-show that we have this little waterfall that's going on and we have the right signals that we are in fact ready to scale. We're ready to take in $10 million and we can spend it in a capital efficient way that will add 10 million in revenue in 24 months. That's the simple rubric for your Series A. So I'm going to wrap up here. Like I said, I help founders prep for their Series A, help them run processes to get multiple term sheets so they can get the best deal terms throughout it. But every time I work with a company, it always starts with this framework. First, you got to find something that works. Then you've got to take that thing that works and do it more often. That's what your Series A is all about. Then for your Series B is when you can start worrying about finding more things that work. That's my last slide. Happy to have questions. You can scan that QR code, connect with me on LinkedIn, reach out there if you'd like. Let me know.
Thank you so much, Michael. It's been great. It was amazing, honestly. Really appreciate it. So I have some preset questions, plus I'm expecting some questions from the audience as well. And just like it's gonna be like a fireside chat that we could do maybe depends on your time allowance, 15 to 20 minutes as you wish, maybe.
Yeah, happy to stay a couple minutes later. Yeah.
All right. So I guess the first question that I have is as we know that investors are becoming more selective and making it harder for startups to raise seriously in the current climate. So my question is like, is the bar higher now for Series A?
Yeah, so my view, I came up fundraising during the Great Recession timeframe. I don't think the bar is higher now. I think that the bar was just lowered during the 2021, 2022 boom times. So I think a lot of people are asking the wrong question of when will it go back to the 2021, 2022 time? And that's not actually true. It's we're kind of this is the normal bar for raising large sums of money. And I think that's a good thing. I think that your company, to be able to raise $10 million and not just burn through that capital and blow up your company, you need to have some element of repeatability. You need to have some element of product market fit in there.
Yeah, that's great. All right. So how about mm, so how about the regional aspect? Like some markets are tougher than others, obviously, and when it comes to raising capital, right? So my question is like, does this change the based on the region in the world? Like depending of the region
Yeah,
and
it's a
how
good question. Um, I I I personally believe that the only real thing that changes region to region is the amount of money you can raise at like a Series A and the valuation typically. Um, Other than that, though, the what you want to be able to show at your Series A should be what we talked about here. What does product market fit look like? Where are you on that journey? How much of it is repeatable? How much is it is scalable? What's your strategy? Um, the more you do that, the easier it is to raise in any jurisdiction, in my opinion.
let's see. It's great. Okay, how about for pre-seed? Because most of our audience here are mostly pre-seed startups, but it's important to get ready way ahead of, knowing all of these in advance for sure. So pre-seed and seed stage founders are often wonder what they should prioritize to make the future fundraising easier, So, what would you suggest for pre-seed or seed stage startups for now?
Yeah, so for pre-seed startups, the easiest advice there is talk to customers. Most people do it backwards. They try to raise capital because they want capital to go build a product so that once they've built the product, they can go talk to customers. The best founders have already talked to lots of customers, have already signed up customers before they even write a line of code. We closed our first six-figure deal at my company before we even wrote a line of code, before we even started a company. that was the impetus for us starting the company, was closing a six-figure deal. Um, so that's how we de-risked it at the time. And so that's what I think that I think every pre-seed founder should be doing that.
I see, I see. Thanks for sharing that. So also many founders face challenges from transition from seed to Series A, right? So where the expectations are more demanding, gets more demand obviously. So what is the biggest challenge when moving from seed to Series A?
For the founder, you mean?
Yeah, for the founders. The
Yeah,
biggest.
I think the biggest challenge is focus and discipline, right? You get flush with a bunch of cash, and
Hmm.
there's almost every seed founder has the same problem that they're drowning in opportunity. There's so much opportunity ahead of them, and they don't have enough resources. They never feel like they have enough resources. And if you're just trying to chase everything, that's where you feel the most pain as transitioning from seed to Series A.
Hmm. So what milestones these at this precedent series stage they should, I mean, you mentioned in your presentations for sure about it. I mean, this is what they're actually asking. What are the some core, maybe top three milestones they should be keeping an eye on
Can
to
you get
move
in front of
forward?
10 customers? Can you get 10 customers to buy? Can you get 10 customers to a happy place? And can all 10 of those customers look and act the same way? Are they the same actual use case? And did they buy for the exact same reason? Did they switch from the same process or way that they were doing something before? Um, that's your pre-seed and seed stage view. So what most I think go wrong there is that they mistake paying customers as happy customers. You need
Mm,
you need happy, delighted customers that have also paid, ideally.
and ideally, these happy customers should become turn out to be an advocator, right? So, I mean, honestly, your presentation is really resonate with us a lot with Open Foco, you know, whatever we're doing at Foco and the co-capital as well. So, especially the part that you know how the unit economics and then the modularity, so to speak, of the startup should be at each stage of fundraising. You know, that was great actually. Okay, here. So some couple of words, you know, about how you can how they can position themselves for better fundraising for the future runs. What's your advice on that?
Talk to 5 customers every single week,
Week, not day.
every day. Minimum, talk to 5 net new customers every single week, potential customers every single week. That's the you'll just increase your learning, you'll increase your network. It's the forcing function for everything.
Okay, thank you so much, Michael,
All right,
and
cheers.
see you. Bye
All
bye.
right, bye now, guys. Thanks, everybody.